All right, my friends, now we have an excellent example to help us review the major issues with respect to accounts receivable. So how do we calculate the ending balance in that allowance account? We'll review those two methods. And then this example goes on to review if we need cash now, can't call J.G. Wentworth. What are we going to do instead? Either pledge our accounts receivable as a collateralized loan, or we'll sell it, and then we'll review both selling with recourse as well as without recourse. Alrighty, so let's jump through and let's bang this out. Here we go. So we know we're doing the allowance method. If you've been out of school a while, remember, as a general rule of thumb, percentage of credit sales, the income statement approach, okay, is no longer going to be what we're going to use. We're going to focus in on the balance sheet, and we want to emphasize that gross amount minus the right balance, that ending balance that we need in the allowance account. How are we going to get that ending balance? And then that gives us the net realizable value for that account receivable. So there are two methods we know to help us estimate that ending balance in the allowance account. So what are those two methods? Well, the first method to come up with that is just take a percentage of your ending accounts receivable. That's one way to come up with that ending balance in your allowance account. The other is a more sophisticated approach using an aging schedule. Okay, so maybe we're going to use an aging schedule instead. But either way, step number one in this process is going to be to come up with that ending balance in the allowance account. Okay, so that ending balance in your allowance account. Alrighty. Now, obviously, if the company is being conservative, we know this is only an estimate. But if the company is being conservative, the higher the allowance, the lower the net realizable value for that account receivable. Alrighty, so next thing I want to do is review with you our T account for our allowance account. So let's do this together. You ready? Our allowance account for our T account. What does that look like? Well, first of all, we know that allowance is a contra asset. Okay, a contra asset. Therefore, it has a credit balance. So if you want to increase that allowance account, you do that with a credit. If you want to decrease your allowance account, you do that with a debit. Okay, so as the allowance account goes up, the net realizable value of your account receivable goes down, so that reduces your total assets on the balance sheet because it's a contra asset. Alrighty, so on our credit side, we have our beginning balance. Alrighty, we'll have any recovery if we write off an account receivable. That reduces your allowance account. So the journal entry to write off an account receivable, we would debit the allowance account. We would credit the accounts receivable to do a write-off. If we ever recover an account receivable that was unexpectedly, wow, it looks like we're going to get paid. This person hit the lottery and is going to pay this bill that we wrote off. Step number one would be to reinstate that account receivable, debit the account receivable, credit the allowance, reinstate it, and then record your cash and get rid of that account receivable. We'll review that as well. Okay, step number one in our process is to find the ending balance in that allowance account. That's step number one. Okay, step number two is then going to be to make any adjustment necessary to get to that ending balance. So if we need to increase that allowance account, if we need to increase the allowance account, we'll debit bad debt expense and we'll credit that allowance account to get it up so we have this ending balance, okay? Or if we ever need to reduce our allowance account, well, how do we reduce any allowance account? With a debit. Then your journal entry is really weird. Debit the allowance, credit bad debt expense. I mean, how often do you credit bad debt expense, right? Not all that often, but if we ever need to reduce the allowance account, then we would have to debit the allowance, credit bad debt expense, okay? But the general rule is when we're increasing the allowance, we debit bad debt expense, credit the allowance, okay? So that's step number two is going to be to find out the appropriate adjustment to the allowance account to get us to that ending balance, all right? And then the gross amount of that account receivable minus that allowance, that ending balance gets us our net realizable value. Good stuff. I mean, I enjoy this stuff. I mean, I also have mental health issues, but that's besides the point. All right, so here we go. Two methods allowed under GAAP to determine that net realizable value. Okay, so we have two methods. So here we go. First example. We base our uncollectible accounts on a percentage of year-end accounts receivable. All right, very simple. Percentage of year-end accounts receivable. Total sales 100,000, 90% on credit, 5% estimated to be uncollected. That's all distractor information. That used to be important if we were doing a percentage of credit sales, but that's distractor information now. Alrighty? This is what's relevant. The allowance account had a current credit balance, so here's our beginning balance of 10,000. So we set up our T account. So my T account, my allowance account, as of right now, has a balance of 10,000. Okay, the year-end balance in accounts receivable is 65,000. So we're going to do a very straightforward method number one. What's our percentage that we expect not to collect? Well, they tell me Kettle Company thinks we're not going to collect 7% of that. Okay, take the $65,000, multiply it by 7%, we get $4,550. That's our ending balance. So step number one, $4,550. Now notice something. In this example, we need to reduce our allowance account. We need to reduce it. We need to get it from 10,000 down to 4,550. So how do we reduce the allowance account? We're going to have to debit the allowance account. We know we'll debit the allowance, credit the bad debt expense. And the question is, well, by how much? Well, we have to go from 10,000 down to $4,550. I can almost do this math in my head. $5,450, that's the amount we're going to have to debit the allowance account for and credit bad debt expense. Kind of weird, right, to be crediting bad debt expense. But nice and pretty. Okay, here's my required ending balance, step number one, $4,550. My current balance is 10, so we need to do what? The adjustment needed is to reduce that allowance. How do we reduce the allowance? With a debit to the allowance account, and then we credit our bad debt expense, $5,450. Alrighty? Beautiful, beautiful, beautiful. Alrighty, now using the allowance method, we know there are two methods. Now we're going to do the second method. Okay, we did the percentage of ending accounts receivable. That was the prior example. Now we're going to focus in on method number two, using a more sophisticated aging schedule to get our ending balance, okay, an aging schedule. And the thought process is the aging schedule, well, you know what? You really shouldn't just look at ending accounts receivable and lump that all together, because as you can see down here, if something's due within 30 days, we're probably going to collect more of that than something that's due from 61 to 90 days or 90 plus days. The longer it's outstanding, the less likely it is you're going to get paid. Alrighty, so we're basing our uncollectible accounts on that aging method. So if I'm taking the exam, the first thing I want to do, we have less than 30. So we have less than 30, 30 to 60, 60 to 90, 90 plus. Okay, tell me the dollar amount, the balance, multiply by the given percentage, how much of that we're not going to collect. Okay, what percentage of that are we not going to collect? And then that will tell you the uncollectible amount for each of those categories. Here, we didn't have to do the math, though. It was given. So in the less than 30, that's 550. Didn't have to do the math. Okay, 30 to 60, 1750. 61 to 90, that's got to be the 3,500. And then the 90 plus days, that's 5,500. So sometimes you have to do this math. Sometimes you feel like a nut. Sometimes you don't. All right, we didn't have to do that math. All right, you take all that, the sum of all of those categories is $11,300. So that's our required ending balance in our allowance account. So again, our allowance account, we start with our beginning balance, no change in the facts, beginning balance, current credit balance, $10,000. Okay, we have a desired ending balance of $11,300. That's step one per our aging schedule, where we did not have to do the math. The dollar amounts were given, but if they weren't given, we know how to find that. Okay, guys, so you know we're going to have to increase our allowance account. We're going to have to increase it by how much? Obviously, $1,300 that we're going to need to increase that allowance account. Okay, obviously, how do we increase the allowance account? Well, obviously, that's done with a credit. So what would be our journal entry? Okay, step number 1, per our aging schedule, we have a required ending balance of 11,300. We have a beginning balance of 10,000. So the adjustment needed, we need to increase that allowance account. How do we increase the allowance account? With a credit. What would be the debit? Bad debt expense. Then we would credit our allowance, $1,300. Okay, and then remember, on your balance sheet, you've got your gross accounts receivable. Okay, I believe that was 65,000 minus the ending balance in your allowance account. Your ending balance in that allowance account, in this case, $11,300, our required ending balance per this method, and that's how you would calculate your net realizable value, just in case you ever had to find that number. Alrighty, so pretty straightforward, not so bad. Okay. Continuing our example, now we need to write off a customer's account. Well, how do we write off an account? Okay, so to write off that account, that allowance account, we know write-offs are on the debit side. Okay, so we're going to have to write it off. We're going to have to debit the allowance account. So we're going to we're going to reduce the allowance account. We don't need it anymore because we're writing it off. We reduce the allowance account, no longer needed, since we are going to eliminate that particular account receivable. So you reduce the allowance account with a debit. How do we reduce an account receivable? Well, with what? A credit. Okay, so our journal entry, we would debit the allowance account. We would credit our accounts receivable for $5,500. $5,500. Okay, now remember, whenever you reduce a contra asset, when you reduce a contra asset, what happens to your assets? They go up. When you reduce accounts receivable, an asset, what does that do to your asset? It makes it go down. So the net change, okay, to total assets is zero. The net change to total assets is zero. Okay, they cancel each other out. All right, the allowance account makes our assets go up when you eliminate that, but then we get rid of that account receivable. Okay, so they cancel each other out. So our journal entry, debit the allowance account, credit your accounts receivable. Now, I want you to be mindful. What does this do to the net realizable value? Think about it. Gross accounts receivable, as we just said, that goes down by $5,500. That makes your assets go down. We then subtract from that your allowance for uncollectibles, $5,500. Okay? That makes your asset go back up. These cancel each other out. They cancel each other out, right? So what does that do to your net realizable value for your accounts receivable? No change. 5,500 minus 5,500, zero. There's no change to the net realizable value of your accounts receivable because you're eliminating both the asset and the contra asset. Okay, since you're eliminating both, they cancel each other out. Beautiful. All right, let's keep banging it out. We're on a roll, baby. We're on a roll. Okay, now we want to recover. Hey, they unexpectedly are paying us $3,500 we did not expect to get. So folks, that's done in 2 steps. Okay, 2 steps. Step number 1, you got to reinstate that account receivable. You reverse the entry to write off that account receivable. You got to reverse the entry to write off. And then step number 2, you record the cash collected. All righty, remember, your allowance T account, write-offs are on the debit side. You got your beginning balance. If you ever recover an account receivable, you got to increase that allowance, put it back on the books. You wrote off the allowance, you now have to recover it. Okay, and we will recover it with a credit. All righty, so what's our journal entry here? Nice and pretty. Okay, step number 1, we reverse that entry that we made to previously write it off. So we reinstate the account receivable, reinstate the account receivable and the allowance account. So it's very simple. You know, if you need to put an account receivable on the books, you got to debit the account receivable. So if you debit the account receivable, you credit the allowance. Alrighty. So basically, the gross amount of our accounts receivable just went up by $3,500. Our allowance account just went up by $3,500. An asset went up, and a contra asset went up. Thus, the net realizable value of our accounts receivable, no change. Okay, the net realizable value of our accounts receivable, no change. They cancel each other out. An asset went up and a contra asset went up. When a contra asset goes up, assets go right back down. So they cancel each other out. Step 2, you get paid. We like when we get paid. We debit our cash, credit our accounts receivable. Okay, one current asset goes up, another current asset goes down. No change in current assets other than a change in form. Okay, current assets in terms of dollars, there's no change to the current assets in dollars. But what we do have is a change in form. The account receivable did what? It turned over into cash, which is something we want to see. We want to make sure those receivables are eventually being collected. Okay, so there's no change in the dollar amount for current assets. Total current assets and total assets don't change. What does change, though, is the form. Instead of having accounts receivable, what do we have in its place? Cash. Show me the money, baby. Show me the money. Okay, so that wraps up all that stuff. Now let's review we need cash now. Okay, if we need cash now, what could we do? You can pledge or assign your account receivable and have what's called a collateralized loan. A collateralized loan. Okay, a collateralized loan. If it's a collateralized loan, do not remove your account receivable from the balance sheet. Okay, we have a footnote noting that some of these accounts receivable have been pledged as a collateral for the loan. You do want to record, though, the cash net proceeds from the loan and the note payable. That you do want to record. Okay, so when you pledge or assign accounts receivable, it's a collateralized loan. By pledging collateral, that reduces the cost of borrowing for the borrower. Okay, and I'll show you the journal entry. Do not remove the account receivable from the balance sheet. It's a footnote only. Record the cash net proceeds on the loan, and I'll show you how to calculate the net proceeds as well as the note payable. Okay, or we can record a sale. Okay, we can sell our accounts receivable, and we'll review that without recourse versus with recourse. Okay, you could sell the account receivable. If it's without recourse, you remove the account receivable from the balance sheet. If it's with recourse, then you're either going to treat it as a collateralized loan or as a true sale, and we'll see that in just a second. Okay, but when you need cash now, alrighty, what you could do is either pledge, option number 1, or sell your accounts receivable. Alright, so we'll review all that right now. I know you're excited. Alright, so at the end of year 2, Kettle Company determines it's going to pledge or assign. So what does that mean? Do not remove the account receivable from the balance sheet. Footnote only. They're taking $350,000 of accounts receivable and pledging it for a loan. The loan amount is $275,000. Now, they record a 2% financing fee. Now, read carefully. It's not 2% of $275,000. It's 2% of the accounts receivable that have been assigned. Alrighty, so step number 1, step by step. You ready? Let's calculate our finance charge. Our finance charge is $350,000. The account receivable that's being pledged times 2%, $7,000. That reduces the net proceeds on the loan. Okay, that's going to reduce your net proceeds on that loan. Okay, step 2. What are our loan proceeds? Okay, so the amount of the loan was how much? $275,000. We then subtract the $7,000 finance charge, the net proceeds are $268,000. That's our net proceeds, okay? Do not remove the account receivable from the balance sheet. We do not remove account receivable from that balance sheet. We do not credit that account receivable. We do not remove it. Footnote disclosure only that, hey, we've pledged this as collateral for a loan. And why are they pledging $350 if the loan is only $275? Well, the bank wants to be over collateralized. Okay, if the borrower defaults on this loan, they want to make sure they have enough assets they can seize to settle that debt. All right, and we know that from business law if you studied reg, right? Collateralized loans. All right, you're like, shut up, stupid. Don't talk to me about anything in reg. So here's our journal entry. Does the account receivable need adjusting? No, only a footnote disclosure. Okay, so I call the debit to cash, I do this last. That's kind of your plug figure. Okay, you're going to debit your finance charge for the $7,000. You're going to credit your note payable. This is the loan amount. Okay, the loan amount, the gross, $275. We didn't borrow $350. We borrowed $275, but pledged $350 as collateral. The finance charge was 2% of the accounts receivable that we pledged. We know that. And then we back into the $268. The $275 loan minus the finance charge, there's our net proceeds, $268. Okay, so that's kind of like your plug figure. All righty, so that is a collateralized loan. Okay, another option is we need cash now. We're going to sell it, and we're going to sell it without recourse. We're going to transfer it, sell it, and we're going to sell it without recourse. When we sell without recourse, you got to remove the account receivable from the balance sheet. Okay, and how do we remove an account receivable from the balance sheet? With a credit. Okay. Now, what's going to be our journal entry? You ready? So we determined that we're going to transfer $350,000 of accounts receivable. Stop right there. So we're going to actually have several debits, as you're going to see. But we're only going to have one credit here, a credit to accounts receivable, $350,000. We're getting rid of that account receivable. Okay, so what are all the debits? Well, we're going to get cash. You do that last. That's going to be your plug figure. Okay, you're going to have a loss on sale. Okay, what's our loss on sale? You ready? The factor charges a 2% fee. That fee is a loss on sale. It is not a financing charge on a loan. So it's not a financing charge on a loan. It's not a loan. Okay, before we had a financing charge because it was a loan. This is not a loan. So it's not a financing charge. It's a loss on sale. How do we calculate that loss on sale? You ready? Take your $350,000 accounts receivable that we are selling, multiply by the percent that the factor is charging, 2%. Okay, we have one piece of the puzzle, $7,000 loss on sale. Okay, the factor is also holding back 2% of the receivables. They're not giving us that cash yet. The factor is holding back $350,000 times 10%. They're holding back $35,000 that they might give us if the factor collects the entire $350,000. So they're kind of holding that as security. Okay, so we call that due from the factor that we might get. And this is negotiated between the seller and the buyer, the factor. And they negotiated, well, hey, the factor says, you want me to buy your receivables? I'm holding back 10% in case I don't get paid. Alrighty, so we take the $350,000. We might get this in the future, $35,000. Okay, so that reduces your net proceeds. So the net proceeds are what we're going to do last. Alrighty, we back into that. So I have a credit of $350 minus the $7,000 loss minus the $35,000 due from. What does that give us? $308,000. There's the cash received. Okay, $308,000. Okay, so when you sell without recourse, we're going to remove the account receivable from the balance sheet. Okay, there's only one credit. When you sell without recourse, only one credit. When you sell without recourse, only one credit to account receivable, period. Okay, there's just one credit, and then we have our debits there. Okay, so our journal entry, nice and pretty. We debit the cash. This is the net proceeds. Back into that, please. You do that last, but we know we're going to have that debit. We know we might get another $35,000 in the future, and they're not giving it to us today. It depends upon how much of that $350 the factor gets. We know we have a loss on sale, not a financing charge. A financing charge is when it's a loan, so it's a loss. Remember, financing charge, you see that when we have a collateralized loan. A collateralized loan. Okay, when it's a sale, it's a loss. Alrighty, $7,000. And then we back into the 308, the 350 minus the 7 minus the 35, and whoop, there it is. Alrighty, now let's take a look at another scenario. Okay, now they tell us we're going to transfer $350,000 of our outstanding accounts receivable, but this time it's with recourse. Okay, it's a transfer with recourse. So whenever we have a situation where it's a transfer with recourse, it could be treated as a sale, in which case we would remove the accounts receivable, but we're going to have two credits, as you're going to see. Or it could be treated as a collateralized loan, okay, in which case we do not remove the account receivable from the balance sheet, footnote only. Okay, we record the loan, we have a footnote only, and we record the loan proceeds like we did earlier. Okay, but we do not remove the accounts receivable, we just record our cash, we record our cash, our financing charge, and then our note payable like we did earlier. Okay, now, if it's treated as a sale, sometimes they tell you, hey, really easy, it's treated as a sale. But what if they don't tell you? How would you know to treat it as a sale? So if they say nothing, if the question is silent, treat with recourse as a sale if we meet these conditions. We have to meet these conditions. Number one, seller's obligation for uncollectibles can be reasonably estimated. Reasonably estimated. Okay, the seller's obligation for uncollectibles can be reasonably estimated. This is going to be called the value of your recourse liability. And that will be a credit when we do the journal entry and increases your loss. Okay, and I'll illustrate that in a second. But if the seller's obligation for the uncollectibles can be reasonably estimated, a quote-unquote value of a recourse liability, that will be a credit in our journal entry and increases our loss. Number two, the seller has to surrender control. Whoever buys the accounts receivable can sell them again if they want. And step number three, seller cannot be required to repurchase any accounts receivable. Okay, seller cannot be required to repurchase any of those accounts receivable. Okay, so if you see it's a transfer with recourse, they can either tell you treat it as a loan or treat it as a sale. If they say nothing, you know to treat it as a sale if these conditions are met. Okay, so you're about to see, we're going to debit cash. Okay, we're going to do that last. That's going to be our plug figure. We're going to have a loss, which is going to be the sum of two amounts, as you're going to see, the sum of two amounts. We're going to have a due from the factor again, due from the factor, as you'll see. We have two credits, though. Credit number one, accounts receivable, and then another credit, our recourse liability. Okay, so we'll have three debits and two credits. Alrighty, so it's a little bit different than a true sale because we have two credits. Okay, so if it's a transfer with recourse and you're treating it as a sale, this is going to be the key to getting it right. Okay, to remember this credit. for your recourse liability, and then your loss is the sum of two amounts, as you're about to see. Now, I know you're excited. You're like, shut up, stupid, and show me the example. So, boom, here it is. You ready? So we're going to transfer $350,000, alrighty? So we know we're going to credit our accounts receivable for $350,000. So we're going to have a debit to cash. We're going to have our loss. We're going to have due from our factor. We're going to have our accounts receivable, $350,000. And then we're going to have our recourse liability. Recourse liability. Okay, we have one piece of the puzzle. Okay, we charge a 2% fee. The factor charges a 2% fee. That's going to be a loss. So $350,000 times 2%, $7,000. That's part of our loss. Okay, they're retaining 10% of the receivables. $350,000 times 10%, $35,000. That's going to be our due from. We might get that later on. So due from, we have one piece of the puzzle, another piece, $35,000. Now they estimate the fair value of the recourse liability to be $1,000. We add that to the 7 to get our total loss of 8. There's our total loss, $8,000. The $7,000, the 2% fee, plus that recourse liability of $1,000. So the sum of the two is 8. So our loss, the $7,000 plus that $1,000, that's $8,000, and that recourse liability goes there, $1,000. Okay, and that's the key to getting this right. Your loss is the sum of two amounts, the 2% fee and the recourse liability, and you have an additional credit in addition to that accounts receivable. So now, add up your total credits for me. You ready? Your total credits are $351. Take your total credits minus your debit of $35 minus your debit of $8. What's got to be the other debit so that our balance sheet balances? Well, it's got to be $308. Okay, it's got to be $308. Okay, so that's a with recourse example where it was treated as a sale and they told us it was treated as a sale. We didn't have to read into it. Alrighty, so one more time, your journal entry. Okay, we remove the account receivable. So if we treat it as a sale, we have to remove our accounts receivable. So the account receivable comes off the balance sheet. This is our recourse liability given information. Okay, the loss on the sale was the sum of the 2% fee plus that $1,000. Okay, so the 2% fee plus the $1,000 given liability. The due from factor was the $350 we sold times 10%, and then we backed into the cash. The sum of the credits, $351. The sum of the credits minus the debits. We have a debit of 8. We have a debit of 35. What does that give us? You back into your 308. And there you go. Alrighty, so this was an outstanding conceptual. Kudos to the writers of this example because they did a beautiful job in putting that all together. Alrighty, guys, so that wraps that up, and now we'll look at another example illustrating accounts receivable, the allowance method. But let me give you a second to digest that.